Hi, welcome to Market in a Minute. I'm Patrick Adams. So, technology is 50% of the S&P 500. It wasn't even close to being that amount uh, back in the 1990s, at the end of the cycle in 2000. So, just a little story. In 1999, I was the chief investment officer and I managed the largest portfolio, the flagship portfolio at the Berger Funds. The folks at Fortune magazine, they were doing an article on tech investing, and they came out to Denver. They flew in a number of different managers from around the country, about six of us or so. One of them was Munder Net Fund. I'll never forget that. That thing, boy, did it puke back in the 2000s. That thing's no longer around, but that gives you an idea. So I was the only guy that showed up for the interview without a tie. And then I was the only guy that showed up that was negative. Okay, this is 1999. So how I was playing that tech cycle was I'm not exposing my clients' money, my portfolios, my mutual fund to having a market weighting or more in technology. But what I was doing was I was buying a laggard, so I was making some really good money, had really good performance. At 50% of the S&P 500, we call this a bubble. This is a bubble. Okay? You could argue that the companies are better this time, no doubt about it. You could argue a bunch of other stuff. Okay? At 50% of the S&P 500, I don't care what your argument is, it's a bubble. It's too large, okay? This is a spending cycle. So we are in a spending cycle. It's the biggest spending cycle of all time. But should it be 50% of the S&P 500? Maybe, okay? Maybe it should be that, but it's not sustainable. It's going to come down. Over time, there's going to be less money spent, or at a rate of change, at a minimum, a rate of change is going to slow down. Stocks don't like negative rates of change, they like positive rates of change. So we're going to talk about how to invest in a bubble. Disclosures, please read those at your convenience. So technology and technology related, okay? So you have to include the companies like Google and Amazon into the related. So technology related, that gets you 50% of the S&P. There's a whole bunch of other companies coming, IPOs coming, and three right in front of us: SpaceX, OpenAI, and Anthropic. That's at least probably $4 trillion that's going to be added to the markets. That's one way of creating money supply. But $4 trillion added to the markets, if they all go in the S&P 500, and they'll probably go up in price when they come public, that's at least additional 6% added to the S&P 500. So one of the things I do every weekend is I look at the valuations of all the sectors. I put PE multiples on all the stocks that we cover. So there's 20 pages, okay, 20 pages of this. So over the weekend, I sat there and I said to myself, felt like John McEnroe, you cannot be serious with these valuations. They're way too high. Okay, the stocks are being priced as this cycle is going to last forever. Maybe we're in the middle innings, maybe we're later, but it's going to slow down and it's going to roll over and it's going to start to decline at some point in time. So this bubble is going to burst. The timing is just what's in question, not if, but when. We don't think you need to run and hide, but you need to know the risk, okay? And then don't drink the Kool-Aid, okay? Don't be that fund back in 99 that was plowed into tech and that blew up when the Nasdaq went down 80% from high to low. Don't be that guy, okay? Know where we are and be willing to get rid of some of these stocks as they go up. So what we're doing is we're taking profits. We're buying some really good companies that have worked out really well, and we're looking at things that have lagged. So you can make some really good money that way. So what we've done in the most recent past is we focused on the semiconductor companies, not the commodity stuff. Frankly, we were early on that, made some money, got out of the memory chips. Then we moved on, Marvell, Texas Instruments, some of the other semiconductors, Intel. Okay, we played that. That's worked nicely. Okay, we pulled back on those. Recently, we got into the software companies. We probably picked that off right around the bottom. We talked about this on a video, and we'll mark in a minute, about buying, the software names when they were just absolutely obliterated right at the bottom. ServiceNow is one that we really liked. That started to perform really well. And so we think that the market got really overly negative on software. We think there is an issue for software, but we don't think it's as big as the market expects. Now, what we've been doing recently is we bought HPE, Hewlett Packard Enterprises, because it traded at such a big discount to Cisco. Trade at a third of the multiple of Cisco. They had bought Juniper Networks, which was one of our favorites back in the 90s. Loved Juniper Networks, loved Cisco. Juniper generally traded at a lower multiple, so that was a way of playing that trend. But HPE, huge discount. We thought we thought that they were starting to turn. The stock was starting to turn. The business momentum started to improve. Buying Juniper Networks was a big positive, cost savings, and plus synergies. So this stock's starting to work. So we bought it around 30. Usually we pick them off right at the bottom, right? So this one got a little bit away from us initially, and then it's starting to perform beautifully now. Hewlett Packard, the PC maker, we bought that recently. That's up probably 50% from where we bought it just a few weeks ago. We see the umbrella created by Dell. Okay, Dell's performing really well. No reason why Hewlett Packard won't perform well. We also really like what NVIDIA is doing on creating chips for PCs. So AI chips for PCs. That's really going to drive probably the spending on the personal computers. We were thinking that this is going to happen for a long time. That a lot of that computing, that computing that's necessary with AI is going to be pushed off to the fringes of the network to the PC, rather than everything having to be done at the data center. So there are three types of investors, in my opinion: growth at a reasonable price, which is this. I believe this is what I am. A lot of people think I'm a value investor, but I'm not. I got to have growth, but I'm not going to buy it expensively. So the momentum guys think I'm a value investor, and I guess in some degrees I am. So I want to buy growth, but I want to buy it at a prudent valuation. And when the valuation gets too high, I want to go off to the next company. And if there's companies in there that we can hold for a long period of time, hallelujah, let's do it. But I want to buy stocks at attractive prices. So that's what we're doing here in the tech group. We're buying stocks at reasonable prices that have good opportunities still left in them. Momentum investors, what they do is they don't care about the valuation. They care about the story and the price of the stock. So as long as that price of the stock is going up, that they want to own it. And generally what happens is they perform remarkably well towards the end of a bull market, and then they get slaughtered during a bear market. Value investors perform really well during a bear market. They may not be going up a lot, but they're not losing, a lot of money during those periods. I think you can start buying some value now. I think it's appropriate to do so. And we could probably see, if energy prices come down, a big rotation into value. This is the earnings for the S&P 500 for this year. So you see the energy up roughly 65% in growth. So this is low quality earnings. Guys, everybody knows, and we bet you on this, that the earnings for the energy sector very likely to be down next year. So we think that the war in Iran is going to be over at some point. Oil prices will come down. Energy earnings will also come down because of that. So these could actually turn negative next year. So the S&P 500 is paying for these earnings in aggregate. Technology the same way. So what's going up in technology is very recently it's the commodity chips, the memory chips. So this is really driven the expectations up for technology. Same way with materials, it's being driven by commodity prices. So you got really poor quality earnings for the S&P 500, driving the S&P 500 up. I don't like that. So I want to buy the high quality earnings. I want to buy the strong companies. Consumer services companies look pretty attractive to us. So, these are companies like Google. We still like Google. And there's other areas that have lagged quite a bit. Consumer discretionary, the industrials a little bit, financials in a big way, consumer staples. Now, it's really tempting to buy those. However, they're not growing. The valuations are great, and they're probably going to be great performers in the next bear market. You can buy these for the income. So the income-oriented investors, there's lots of opportunities in the consumer staple space. Healthcare, all the opportunities is in the emerging part. So let's talk about that a little bit. So ASCO was this past several days over the weekend and into this week. So the American Society of Clinical Oncology. Now, when I went there, 10, 15 years ago, I'll never go back, but there were probably 80,000 people there, overwhelming in Chicago. So what came out of that? Revolution Medicine announced their pancreatic cancer drug. Okay, this data was already out, not a big surprise. This is for second-line therapy. Okay, so they presented this at the conference. And at the conference, they said that the overall response rate was 31.6%, roughly 32% overall response rate. So that's similar to Keytruda. They're in the 30s as well. So not everybody responds to it. And then the median overall survival was 13.2 months. And the standard of care, meaning chemotherapy, is roughly 6 months. So they doubled the overall survival. When you looked at Immuneering, okay, this is one that we really like. I really like this company, okay. And granted, I'm a GARP guy. Valuations matter to me. Okay, their overall response rate was 36% better, right? And the median overall survival was 17.3 months. Better, yeah. This is phase 2 data. They're going for first-line therapy. Now, I'm not sure what RevMed has to do to get out of that second-line therapy to first-line therapy. They may have to do another trial. So when I look at these two companies, I've got Immuneering, IMRX, with a roughly 300 million market cap, 200 million in cash. They don't need cash. And I got Revolution Medicine at a $35 billion market cap. There's something wrong with this, right? Clearly, there's something wrong with this. I don't see it in the data. I think the data is clean. I talked to the smartest guys on Wall Street that cover the stock. Okay, they had the same conclusion. I think what should happen is Merck, who has Keytruda coming off patent, 35 billion in revenues, something like that, right? Huge drug. Okay, why wouldn't you buy this platform company? Okay, these drugs are going to work on different cancers. Okay, Immuneering has one that's already going into lung cancer. I think that's a phase 3, if I remember right. But they're also going into lung cancer as well. So this can work on any cancer type. This is a platform. So Merck would be foolish if they didn't come in and say, just pay $3 billion. That's 10 times what the stock's currently trading at. And you have something that's of great value that can replace the revenues you're going to lose off of Keytruda. So I would sure like to have a 10x return in my portfolio this year. So come on, Merck. Emerging healthcare, this is one of the strategies I manage. It has roughly a 10% position in this company. So in other strategies, we think it's a risk worth taking. So it's maybe a 3 to 4% position. Okay, at 4%, if I get a 10% return on that, that's a huge pickup in performance. Huge. We had one like that last year. It was beautiful. So just keep in mind, we are in a bubble. This bubble could last a while. Okay, you just have to understand where we are. It's a cyclical bubble. This type of spending just it can't last forever. Uh, People are just going to run out of money, basically. But you may have, 6 months, or you may have a couple more years left in it. But you have to be ready for it. Don't have 50% of your money in technology like the market is. If you own the S&P 500, have a defensive strategy around it. So be able to protect yourself if you need to. Be able to sell off a portion of the portfolio or even hedge the portfolio when the market actually turns negative. So if you have any questions, come to my website, Patrick Adams CFA. Also sign up for a hard copy of Market in a Minute. We'll send it to you every week. And then come over to the PVG Asset Management and see what we're doing over there. I think you'll find it very interesting.